The infinite banking concept, I like to define it in 4 words: reclaiming the banking function. It's a grassroots, foundational financial strategy where you can cut out the commercial retail bankers from your life. If somebody says, how do I know it looks right? Here's the 5 rules. The first rule is think long range. Setting up a quote-unquote bank, a corner bank that you can have access to for you and your family to finance your business, your lifestyle, whatever. The second one is don't be afraid to capitalize. If you own a bank and you capitalize that bank with $10 million to get your charter, are you going to stop there? The third one is don't steal the peas. That's the grocery store analogy. It means if you take out a policy loan, pay it back. And Nelson says pay it back at a higher interest rate than what the insurance company is charging you. Don't do business with banks is the 4th point. Number 5 is probably the most important one. That's rethink your thinking. And that's constantly learning, constantly reevaluating what you're doing and why you're doing it. Continue to grow, continue to educate, continue to read so you're not just stuck somewhere.
I have no problem at all with the principle of saying we're not going to do business with banks, period. Where I have an issue is when people use that and then gaslight me, telling me it's better financially for them personally, when it's actually not.
Everything's good with the bank until it's not. When they want their money, they're not nice people. That's the bottom line.
David Stearns, welcome to the BetterWealth Show.
It's great being here, Caleb. Thanks for inviting me. It's been a long time coming.
It's been a long time coming. I'm grateful that you're on. We're going to get into lots of things about infinite banking, the Institute, your leadership, the direction of the Institute, the direction of the infinite banking concept itself. But I think it would be great to define the term infinite banking concept. And we'd love to hear it from maybe not Nelson's mouth, but maybe one of the people closest to Nelson. And so how would you define the infinite banking concept?
The infinite banking concept, that's 3 words. I like to define it in 4 words: reclaiming the banking function. Okay, simple as that. It's a grassroots, foundational financial strategy where you can cut out the commercial retail bankers from your life, and by reclaiming the banking function, using the permanent whole life insurance policy as the platform system of policies. And there's a lot of confusion out there about reclaiming and recapturing interest. Okay, that's always a point of contention. How do you reclaim, recapture interest? Well, you're essentially replacing that number, with generating more income through the banking function through your system of policies. So that's what it is. Okay, so why is that important? Why is it important to reclaim the banking function? Well, most people don't, from my perspective, most people don't even understand what that means, because everybody needs a bank. Everybody's got a checking account. Everybody's got a savings account. Everybody has a direct deposit in their bank. So do I replace all that? Well, probably not, right? But if you becoming your own banker and you see what the problem is in becoming your own banker, 26 years ago it was written, but essentially nothing has changed, right? Most people finance everything they buy either by paying cash and losing interest they make, or paying interest on loans. So if you can recapture that interest flow, that cash flow, then you're going to be much better off than getting 5 or 10% on your investment portfolio. So that's just simply what it is. It's just a paradigm shift, a mind shift, to rethink your thinking kind of thing. That's what it is.
The 2 things that come to my mind as you're talking, the analogy that Nelson wrote is if you distributed money equally to everybody, within 5 years, 97% of money would be in control of 3%. I could be getting some of those numbers wrong. That's based off of memory, but that concept is like, okay, why? And there are institutions and people that understand that the real value is controlling the flow of money, and
Right.
understanding and focusing on the flow, not just rates and all. And I know that was something that Nelson kept on talking about, and it was one of those things until like you're numb in the ears. It's like it's all about capturing the flow. And then the other thing is volume versus rate when it comes to the vaccine concept, and that again, it just resonates is like, do we care about maybe how fast the liquid's going into our arm? No. Do we care about the volume and maybe potentially how toxic it's going in? Yes. And so those two things come to my mind as you talk.
Yeah, I mean, exactly, and it's not hard to understand these concepts, but most folks just don't think about it. And we talk about the rate versus the volume. Interest rate, okay, I got a 5% interest loan, uh, but how many years is that loan going for? 30-year fixed rate mortgage. So what's the volume of interest you pay over that 30 years? It exceeds the principal on the loan. So small interest rate, large volume. Okay. So a lot of rich people, define rich, it's not about how much money they have in the bank. It's about how much they control the banking function, how much they control the cash flow. Okay. Uh, if you're not in debt to an outside institution, then you don't sweat every month when bills come up because you don't have any bills. So you
Mhm.
generate capital inside your infrastructure. You know, Money is something that folks don't really understand what it is, okay?
Yeah.
And, all it is a medium of exchange. Okay, the real measure of wealth is how much capital do you control, you know? So, anyway,
Yeah.
I'm a simple kinda guy,
I love it. I
okay?
love it. We're gonna have
I
fun
mean,
today.
I am. I was an art major in college, so there you go, okay? Because I wasn't a real good student, but I like to do art stuff. So it's like, "Hey, man, this is gonna be easy." Uh,
One thing I asked my guests before recording is I was like, "Hey, anything off limits?" And you're like, "Nope, I am who I am. Let's roll." I appreciate that. I appreciate that about you. I wanna know I'm gonna ask you lots of questions about what you just mentioned, but I wanna take a step back, get to know you a little bit more. How was Nelson as a father-in-law? There's not many many people that could, have that perspective. So I'd love to know that, and then I want you to be able to define the institute. What is the institute? How does it work? And what's the vision of that? But let's start with like how are you connected with the late R. Nelson Nash?
well, like you said, he was my father-in-law. Um, I was in the Army, so art major equals no job, okay? Um, my father was a Army, career officer, so I grew up as a Army brat, so I understood the culture. And when I was going through college, I always thought, well, if I can't make it as an art major, I was going to the Army because I liked it as a dependent. Of course, that's obviously different. But long story short is, so I ended up, going through enlisted in the Army, going through OCS, Officer Candidate School, got commissioned as a field artillery officer. My first assignment was the 25th Infantry Division, which is stationed in Schofield Barracks, Hawaii. Great assignment. Um, Anybody who's been in the military, the whole thing is predicated upon your unit you're in. Okay, the unit makes it or breaks it for folks. I happened to be in a great artillery battalion. It was a great commander, great officers and enlisted and NCOs, and I sponsored this guy named Barry Nash into the unit. I got there in September. I was told, "Hey, listen, this guy Barry Nash is coming in a couple of months. You're going to be a sponsor. Write him a letter and tell him what to expect." So I did. I wrote him a letter. "Hey, listen, I'm going to pick you up at the airport. Tell me what time you're getting in. Let me know if you have any needs besides, whatever." Da, 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 da. So we immediately connected. I and brought him into the unit. We were stationed in Schofield together. He lived on post in the bachelor officer quarters. I lived off post, but um, we got become good friends, Barry Nash, um, and we had a 6-week exercise in Korea in February. So you go from tropical Hawaii, absolutely 85 degrees and beautiful, and then you get on a C-141, and you sit in the back of a C-141 in the cargo area, and you travel to Guam for 12 hours, and you go to Korea for another 8 hours. You get off, it's like 30 degrees. It's like, oh my gosh. Anyway, so we really bonded in Korea, and Barry kept telling me, "Hey, when we get back to Schofield, my sister's gonna be there. I want you to meet her." I said, "Why's your sister gonna be there?" He goes, "Well, my dad is, he's an insurance guy, and he always wins all these trips and stuff because he's a top of the table kind of guy. And so they're going to Waikiki for a insurance event. He's bringing my sister. So hey, you need to meet her. She's really cute. Da, da, da. I said, yeah, right. Heard that before, right? So long story short is I kept pushing him off. No, 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 no. Anyway, a couple weeks later, after we got back, his parents left, and Kim, his sister, said, "Hey, can I stay with Barry for another couple of weeks?" And Nelson said, "Yeah, you can stay. You're getting an open ticket. You can stay. You have to get back, whatever." And so Barry kept working on me. Finally, I met his sister, Kim. And long story short, that was in April. Long story short, we got married in August. So April, May, June, July, August. So
Oh my
5 months later,
goodness.
we got married.
Obviously the sparks were flying and there's chemistry, but was there also an incentive from the military to say, hey, if we like each other, let's get married? How did that all work?
No, it was none of their business. I mean, we just started dating, and she, we just, I mean, I don't want to use the L word, but I guess we fell in love. We started dating, and we did, did a lot of things together. And her ticket came up. She had to fly back, and so she called up her dad and said, "Listen, I really want to stay here longer." And he said, "The only way you can stay there if you get a job." And it's like, I don't know if you've been in Hawaii or not, but if you're just like off the airplane from Birmingham, Alabama, you're probably not going to find a job. Anyway, long story short, she found a job on the North Shore in like a bikini shop up there. And so he said, "I got a job." It's like, okay, you can stay. Anyway, so we just said, "Hey, listen, let's not wait. Let's not linger because you're living with your brother. I'm living over here. I can get quarters on post on Schofield Barracks. The best time to get them is the end of the summer because they rotate families during the summer season. So the best time for me to get quarters is August, and I can't get them unless I'm married. So if you want to get married, let's think about doing it now." It's like, she's okay.
Why wait?
Here's the punchline. The punchline is I had never met Nelson Nash, her father, or her mother.
Did he know that you were dating at least? Obviously, that would be the reason why she wanted to stay in Hawaii.
Barry told the whole story. Everything was legit. So anyway, so they flew in I think I get this wrong. Kim corrects me all the time, but I think it was 2 days before the wedding. And we just don't think wedding like you see it nowadays. The wedding was in Cannoneer Chapel on Schofield Barracks, a little World War II chapel that held maybe 100 people. One of the installation chaplains married us, and my reception was in the backyard of my battery commander. We had a keg of beer and a potluck spread. And that was it. Okay. But anyway, so Kim and I picked up Nelson and Mary, and I think it was her grandparents flew over with them, picked them up at the airport, and Kim found a place for them, a little kind of cottage hotel type thing up on the North Shore. They stayed there. We got married, boom, and they stayed a week, and we hung out together a little bit, and that was that. But it's after I picked Nelson up at the airport, he goes, "Boy, we got to talk."
Yeah, no kidding. I was like,
we got to talk. So I was like, "Ooh, okay."
And you never talked to him over the phone?
I didn't know. I thought I was going to get the riot act because, I spent a lot of time in the South as a military dependent, but it was on an Army installation. So you're not really ingrained in the Southern culture. You don't just marry somebody in the South. At least you didn't back then. You ask for permission from the dad, face to face, right? And so, hey, listen, man, we're gonna do it. Let's get it done. But what did happen was, he asked me for 3 references after
2 days.
I proposed.
Oh, so did you ask him?
Yeah, this is after I proposed to her back in I guess it was March or.
And you didn't ask for his permission then, but he asked for 3 references.
He asked for 3 references that knew the family, that knew my family and knew me. And so there was a really good friends of my parents and our family that lived in Columbus, Georgia. There was a really good friends that lived in Montgomery, Alabama, and there was another group somewhere else. So he called them up and scheduled a meeting and drove to Montgomery and spent a couple hours with them and talked to them about me and my family. They drove up to Columbus, Georgia, the same thing. So he wanted to make sure I wasn't some dirtbag. Um, so so after we took them up to the North Shore and put them in their place. He said, let's sit down and talk. So we sat down, and the first thing he did, he pulled out his little portfolio and pulled out a insurance applications, what he did. And I still have that original policy in the little trifold they used to come in back in those days, and I show it to everybody. But so I just said, he goes, sign here. I signed there, and it was for a whole life policy from Equitable Life. And that's what he wanted to talk about. He wanted to make sure that I was insured and that, I didn't have any problem, writing a check every month. So,
and obviously he didn't explain the infinite banking concept then, but did you get any term insurance, or do you know how much how much was your premium early on?
This was 1979. Okay, Nelson didn't have all his stuff until after that, all his issues and whatnot until after that. So all he was selling whole life insurance. It was before IBC, but all he sold was whole life. And he'd sell term if it was the appropriate product for somebody, but all he sold was whole life. The premium was probably, Kim can help me on this, it was probably like $50 a month, maybe something like that. It was a tiny little policy, maybe $40,000, face amount, something like that.
Well, you still have it today?
I still have the paperwork. We 1035'd it. We 1035, when Nelson was really upset with Equitable Life, he tells this story also in his seminars. He was one of the top guys, and back there in the 70s and 80s and 90s, especially in the late 80s, after the A.L. Williams stuff, buy term, invest the difference, Equitable decided they were going to start introducing these different variable products, and they had a VUL product, a variable life product. And Nelson said, "This is poison. This is why it's not going to work. Don't do it." And they just basically told him, "Hey, you need to catch up with the times." And then after that, they demutualized. I think it was in 1992. Equitable demutualized, and when they did that, he says, "I'm out of here." So he left them and he joined a Guardian agency in Birmingham. And he finished out his career with Guardian, but he was not in love with exchanging policies, and I don't know why he suggested we do it. It was like later on. It wasn't that early. I have to look at my notes, but I think I 1035 exchanged at least three Equitable policies to Guardian policies.
Wow.
And I have two policies that are still Equitable. The reason I have them because they're on my wife. And at that time, she was uninsurable, so we couldn't 1035 them. But both those policies, even though they're within a stockholder construct, are still paying nice dividends, So it's like I'm thinking maybe I should have kept those old policies because there's nothing better than time when you talk about an uninterrupted compounding period. The sooner you start and the more you keep it going, the better off you're going to be. So my lesson is, don't 1035 anything. I don't care if somebody says that's not a good policy or not. Only 1035 an IUL, a VUL, or GUL, but not a whole life policy. Keep it, okay? And if it's not good for IBC, buy a new one.
Yeah, David. So, couple things. When did Nelson start writing and coming up with the infinite banking concept? And you have a different perspective. You may have not even been paying attention at that time. I'm just curious from your perspective. Did you read the book when it first came out? Did you go to any of the seminars, or is this way after?
Yeah. Well, Nelson had a series of issues he talks about in the book. Okay, he had the quad bypass. His brother, who he worshipped, dropped dead from a heart attack at, I think it was 58, something like that. His first granddaughter, my daughter, was born in Hawaii, And in 5 weeks after that, she was diagnosed with neuroblastoma, cancer, childhood cancer. And so it was like gut punches, boom, boom, boom. And then, of course, he talks about interest rates skyrocketing. But he, he put this together. He didn't label it IBC until, gosh, I think his first trademark that he applied for was in the late 80s. And then the internet banking concept was a trademark. He implemented these strategies in his own life, and he bought as much whole life as he could buy on himself, his children, his children-in-law, everybody, because he wanted to create that system of policies that he could totally replace all his conventional loans with. And then then he started teaching his clients, his captive clients, this is how I'm doing it. So and I witnessed that because I was, at that time, we were down at Fort Rucker down in South Alabama, and he came down to deliver a policy to somebody who lived in Ozark, which is right outside the main gate of Fort Rucker. And I went with him to witness this. I don't know why I did it. I don't know why he invited me. I didn't think about it, but I went. And so he whipped out this policy, and he told the guy, "Sign here," just like me, sign here. And the guy was a good friend of his. He was a client of his, and he probably had, I don't know, 4, 5, or 6 policies. And I think it was a $60,000 annual premium, if I remember. And boom, boom, boom. It's like, so he was doing this himself. And then he started in the early 90s doing seminars in Birmingham. Okay. And he was a Guardian guy back then, like I said, and he would use their facility to do these seminars. And the very first seminar on DVD that he produced was in 2001, and it's actually in a tiered classroom, and that was the Guardian facility he did it in. So he started doing these seminars, and he would have maybe 1, 2, 3, 4, 5, 10, 20 people who would come to him, and he just said, "Okay, I'm going to do these over a 10-week period, and we're going to talk about it for like an hour a night, every Wednesday night for 10 weeks or whatever." And the first week would be 10 people there. The second week would be 9, then 8, 7, 6, and finally one person show up. He said, "This isn't working." So that's why he started doing them over 2 days, because he got a group together, and they basically kept them together. And then he used, and so at that point we didn't move back to Birmingham until 2000.
Okay.
So everything he did up to 2000, I didn't have any idea what he was doing. I was busy. So I was still in the military. We're doing our thing. And I thought he was just, as part of his life business. We had no idea where it was going to go, what it was going to do. And he didn't either. And so somebody said, "Listen, you need to take all your notes and all your stuff and put it in a book, because you're only going to reach very few people unless you get a book out." And so he had everything together from doing this for the last 3 or 4 years. So he just put it all together and self-published a little book. And several people out there who he'd been working with, like Kim Butler was one of them that comes to mind. She said, "Send me 100 copies," and he did. And she loved it. And he refined it, first edition, second edition, third edition, fourth edition. And he didn't promote it. Okay. It was just word of mouth. And IBC just took off. It really did. And he hired a guy to put together a website for him. And he's working with another couple of people when I showed up. And they produced the audio CDs, and they produced the first DVD set. And then Nelson asked me to work with him in 2001. And that's when 9/11 hit, right? And I said, "Hey, I can't leave the military right now because there's too much going on." And so I finally retired in 2004, and I work with him full time. But I mean, I was still, at that time, we lived in Birmingham, and I was, working here with a unit here. So he would ask me to do stuff, and so I was trying to modernize his platform. I mean, he used VGTs for a seminar.
I'm not sure what that is. It sounds old.
When you went to math class in high school, your teacher had an overhead view thing, and she had a clear acetate thing, and she'd write on it with a magic marker, throw it on that thing, and it would project it up on the screen. That's a VGT. He had those for his seminar, and he had a box of them. So he'd walk in a room with a box, and he'd shuffle through them and put the first one down there about the problem, boom, and then he'd go to the other one about, you know, the typical American, and I said, Nelson, you need you need to get a laptop and with some PowerPoints. He goes, well, do it for me. So
So he wrote the
so
book without a laptop? He wrote it, like how did he write the book without a
he
laptop?
had a desktop computer, big computer, 286 or whatever back then, and clinked it out himself and took it to a local publishing people. But he did not use PowerPoints. He didn't use anything until I showed up on the scene. So I helped him do all that. And he get orders. People would call him up and say, "Hey, I want to order a book." And he'd go, "Okay," and he'd write down all their information and have a nice conversation with them. And most of them that back then, everybody was an insurance agent that ordered the book. Everybody, because they thought it was a great way to sell whole life insurance, and they were looking for ways to do that back then because whole life still had a bad name, back in the late 90s, 2000s. So,
I
I
mean,
mean,
some would argue that it still has a bad name today, but I mean, it had a worse name back then?
yeah,
Okay.
you're right. Yeah.
Yeah, so okay, so then you were with him ever since 2024 or 2004?
Yeah, I retired in December of '04, and I immediately worked with him full time. And
When did he stop running insurance?
he didn't stop writing insurance until like he died. He still had a contract. He still wrote for his family. Is what he did. Um, but he got a contract to the local agency or local Meritas agency. And I bought 3 policies from him, on grandchildren through the Meritas agency. Um, but he maintained his license until the very end. He maintained his contract with the agency until the
Yeah.
very end.
Wow, cool. Talk to me about the institute. There's obviously, how would you define what the institute is? Why was it created? And what's
Yeah.
the vision for it going forward?
Um, the institute, we didn't really create the institute first. What we did was we created the IBC practitioner training program first. Okay, back in the early days, uh, I call it the Wild West. And you might have. What's the first think tank you went to? Do you remember what year that was?
I think it was 2019.
Okay, well, I'm talking back as early as 2000 and like 10 and 11. We used to have think tanks, and it was like people would show up, and we come up with these innovative ways to do things, and it was like crazy
Mhm.
IBC stuff. Um, and it made a lot of people nervous. Okay, because everybody's trying to outthink everybody else and just like, yeah, use your imagination. This is infinite, but some of the stuff was like really crazy. Anyway, um, and so there was a need
Like, what
to
were some of the things that were really crazy, like people laddering policies into infinity?
no. Well, some of the things that came out of that were like we had one guy who never joined a program, but he was a good fella. His son was developed this spreadsheet. Uh, I guess it was based on Excel or whatever the higher level, what is it? I think it was like a multi-page spreadsheet that was massive, and where you see programs now floating around now where you could optimize how you could fund a policy and repay your loan portfolio the best way to
Mhm.
do it, like artificial way to do it, but it was just so fragile and cumbersome. That was one of them ones. We used to have case studies where you go in there and if a business had like $1 million annual cash flow, you sold, $1 million premium, immediately you pulled out as much as you could, and it's just this, that. It was, and then you get another, then and some of the laddering stuff, quote unquote, started back then, and some people are still doing that. By the way, you probably know that, where you buy a policy and you have, it might be a 60 base, 40 PUA. Then after year 3, you drop the PUA and use that number to buy a second policy. Okay, and then after year 6, you drop the PUA for the second policy, use that PUA.
Well, David, that's
Yeah.
when I think of laddering, I think of people that are borrowing against their policy to fund the next policy.
Well, I'm getting there.
Okay, okay.
And so, yeah, so the first 3 years looks nice and clean, okay?
Yep,
Then you start using the policy, and so now you're borrowing from policy A
yep.
to fund the premium for policy B, and also pay the interest on a loan from policy C, and it's just a disaster. And so Nelson and I said, "Man, we have got to build some parameters around this thing."
Yeah.
So we asked a couple of agents that were IBC agents to help us, build a training program. And what they did was their interpretation of IBC and what they used internally if they had an agency was what was used, and it ended up being about them, not about IBC. That's just the way it is, because you want to get your face out there in front of everybody else so you can grab more leads, blah, blah, whatever. And so several of the insurance carriers that were friendly to IBC said, "Listen, you know, Nelson, we're not going to fully get behind this unless you develop an agent training program, because we want to know what right looks like." Okay. And so I thought about it, and I looked at several things several agents had put together, and we talked about it, and this and that, and this and that, and blah, 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 blah. And Carlos Lara showed up on the scene, and he'd been with us because he wrote How Privatized Banking Really Works, integrating the infinite banking concept with Austrian economics. And he said, he goes, "I have a strategy." And I talked about this at the last think tank. He goes, "I think we need to build a training program, but it needs to be an academic-based program, and it needs to be, we work directly with the insurance carriers ourselves. We don't use any agents to help us do this. We go right to the actuaries and figure out how it works from that perspective, and we do it. And you went to the program, you know what I'm talking about." And so we agreed. Nelson and I agreed. So it took us 6 months to put that together, and we unveiled it at the 2013 think tank in February, and we had, I think, 200 people there, and 100 immediately signed up for the course. But it didn't have an application component, which concerned me, because academics are great, but if you're not sitting down with a client, okay, and understand where that client is financially, where that client is mindset-wise,
Mhm.
if they don't understand what you're talking about, then you're wasting your time, and it's gonna be more destructive. So anyway, long story short is we implemented it, and then we said, "Okay, here it is, and we're gonna administer it from the Infinite Banking Institute," which is, Bob Murphy, Carlos Lara, Nelson Nash, and me. And then after a year, somebody said, "That sounds weird, Infinite Banking Institute. It sounds too much like conventional banking." He goes, and so they suggested we call it the Nelson Nash Institute, because that's what we're really trying to do. We're trying to, number one, honor him, keep his legacy alive. And so that's what we coined it. And that was in 2014. And then in 15, to help solve the lack of hands-on training, we created a mentor program where if somebody came into the training program and they needed hands-on help working live cases, then we had designated mentors that work with them. And then at the same time, that's when we started interviewing candidates who wanted to come into the program. We wanted to interview them, so number one, we got a sense that they knew what they were getting involved in. Because some people, all they wanted, well, they wanted to, everybody wants to make money. Okay, we
Right.
get it. That's why part of the training program that we had, the academic program we had, was we were trying to monetize the message. And how do you monetize the message? Well, if an agent does it right, if they have the right training, the right environment, the right coaching, then they'll make a lot of money doing this. And so that's monetizing their their perspective on it, and they will have spread the word. So incrementally, we kind of got those several different things changed. The name of the institute. We've got a mentor program. We're interviewing candidates. We don't want candidates just because they want to. Number one, get leads off a website, or another tool in our toolbox, because they have to understand what this is about, because it's not about just designing a policy and selling whole life insurance. It's about creating a mindset. And if people get it, uh, then they'll want to pay as much premium as they can, because it's not, whole life insurance is not the only, uh, asset you should have, but it should be the foundational one you have, right? So the bigger it is, the more you have access to capital to invest, to buy property, to buy precious metals, to invest in crypto, name it, cash flow and assets. That's a big buzzword, right? Alternative investments. Those are great things to do,
They're
but
just
you
not
have
good
to
foundational assets.
have the foundation to do it. So the institute, what we're trying to do here, you said, what are we trying to do with the institute? Number one, we're trying to create a program where it teaches that. Okay, and it's not about Caleb Gillums versus somebody down the street selling whole life insurance. Is about, let's create a community where they can engage each other, okay, where they can learn together, where they can speak the same language, where
Mhm.
they can, all the noise out there on YouTube and Instagram and TikTok and all that stuff like that. We can't shut that down. Okay, it's just infinite banking's out there, but the best way to battle it is have just as many people saying the right thing.
Agreed. Yeah.
Simple as that. Just say the right thing. Just say what it really is. No, you're not gonna buy a car for free. You're not gonna get rich on buying Rolex watches,
Yeah.
you know?
That's why I was really grateful for your guys' YouTube channel, because now you guys have a platform to call people out, and I think that is a far more effective way to, like, expose people in real time than, the expensive legal route. And so I think
Yeah.
the greater the platform, and then the institute, the people tied to it also have platforms, some bigger than others,
Yeah.
but I think that those are way it's like that credibility feature to say, like, "Hey, if these people have the stamp," and I'm sure you guys have to struggle, because there's people across the board, including myself, that have all kinds of beliefs. You put them into a thing, and not everyone's going to believe the same way. So it's like, how do you, like, what are the core things that you need to have to stay in the institute? And, like, obviously, I know, like, it's a shall now. Like, if someone wants to do infinite banking and you're part of the institute and you sell them index universal life for that, that's a problem, and you can, get kicked out for that. Is there anything else that's like, you know, because there's, like, we can actually have a dialogue. There's some things that you know, have dialogue. I mean, I have a podcast. I talk a lot, and so there's things that come up that it's not like I am, like, throwing everything out, but there's some things that I don't necessarily, quote unquote, agree with. And it's like the concept itself is so powerful. It's, again, going back to reclaiming the banking function, powerful. So I'm just curious, like, where do you draw that line? Because you can't be super, super black and white, or you'll just have no friends and have no institute. But you can't be so
No.
liberal that everyone can get in based on just, like, signing their name and taking the test. Most people have no idea where to start or how to really evaluate whole life insurance. That's why we've built the Vault. It's all of our best life insurance resources and educational tools all in one place, all for free. We have calculators, handbooks, crash course, deep dive videos on numbers. If you want to learn more, click the link in the description or tag comment below to unlock the Vault. All right, back to the video.
No, I mean, yeah, anybody who wants to come in can interview, okay? So we've terminated 3 people in the last since 2013, okay? Um, and the first fellow we terminated, uh, the rules are about termination are in the user agreement, and that's public knowledge on our website. Okay, anybody can read that. It's a document that says, okay, this is what you can't do. Okay, so if somebody reaches out to you, Caleb, and they don't know anything about IBC, and they don't know you're a practitioner, and they contact you and say, look, I see you're an agent in Wisconsin. I want to buy an index whole life policy because I want to do this for it. And so you sell him a policy because that's what he wants. So that's fine. But if somebody reaches out to you from my website, from the Institute website, and say, "Listen, I saw you here. I love IBC. This is fantastic. You're on there. Okay, I want to start implement this process." And you say, "Yeah, I think that even though we talk about whole life policies, I think a better route for you is an index UL policy." You get terminated. Okay, that's simple facts. So that happened one time. Or somebody is a huge public figure on YouTube, and they state categorically, if you're not working with Northwestern Mutual, New York Life, Mass Mutual, or Guardian, you're wrong.
Yeah.
You're wrong. Okay, so hey guy, you can't say that. You can say these are my preferred carriers because of X, Y, Z, but you can't tell clients not to work with anybody else. So it's gone. Sorry, hit the road. So anyway, or you use your practitioner credentials to sell other stuff. You open up with, I'm an IBC practitioner. Let me show you how I can make you 200%.
I see. Yeah, those are all, and those you have to be careful about that, because not to say that there's a Ponzi scheme that they were promoting, but you could easily get yourself into that, and you guys really want to be out of it. You want to, hey, I don't want to be on the other end of how you're using capital and controlling capital. I just want to show you how to do that, but don't be leveraging the institute to try to promote a real estate deal or something.
Yeah. I mean, you can do whatever you want to do. We have practitioners that spend 10%, with IBC whole life policies, 90% with investment clubs and stuff like that. It's like, hey, as long as you talk about the IBC thing correctly, do your thing. We're not cops out here to clean up the marketplace. We just want to make sure that if you have a client, we don't want clients to go back to insurance carriers and sue people. Okay, for misrepresentation. It's all we care about is servicing the public. And IBC, as it was designed and sold and trademarked and copyrighted and this and that, is about properly designed cash value, dividend paying, whole life insurance.
Right.
Okay, used to implement the infinite banking concept. It's as simple as that. And Nelson's got his 5 simple rules or his 5 principles. You've heard about those.
Yeah, don't do business with banks.
Well, it's like, I told you I'm a simplistic kind of person. If somebody says, "How do I know I got it looks right?" Well, here's the 5 rules. Does it check that box? Like, for example,
can you go through the rules just for our audience, those that don't know the 5 rules?
Okay, the first rule is think long range. Right? Think long range. And go back to, setting up a quote unquote bank, a corner bank that you can have access to for you and your family to finance your business, your lifestyle, whatever. So if you're gonna, why create a bank that you can only capitalize for 7 years?
Mm-hmm.
Don't you want a bank that's going to last 200, 300, 400 years, so multiple generations can access those funds and they can leverage that to finance their lifestyle. So think long range. Now, if you're 85 years old, okay, and you want to move $1 million through something, then it might be a different construct. Okay, it all depends, right?
You can still think long range in how you apply that. You can think,
Yeah, think long range. Okay, the second one is don't be afraid to capitalize. Again, if you own a bank and you capitalize that bank with $10 million to get your charter, are you going to stop there? Are you going to continue to capitalize it? So what does that mean? Don't be afraid to capitalize it. Well, it means Uh, don't
Don't
if
be
you can
afraid to pay
afford a
premiums.
$50,000 annual premium, then do it,
Yep.
right? Because one of the things that I see over and over and over again of clients that really get IBC, the stories that we get, and I'm sure you've heard this also, is after 1, 2, 3, 4 years, your client goes back to you and says, "I didn't buy a big enough policy."
Right.
Well, why? What do you mean big enough policy? Big enough policy for a death benefit? No, big enough policy that you can use to finance your business, whatever. You lost capacity, so you buy a second one or a third one or a fourth one. So don't be afraid to capitalize. Okay. The third one is don't steal the peas. Okay, that's the grocery store analogy. What does that mean? Don't steal the peas. It means if you take out a policy loan, pay it back,
Yeah.
and pay it back at interest. And Nelson says pay it back at a higher interest rate than what the insurance company is charging you.
Yeah.
Well, how do you do that? Because you don't get an amortization table from the insurance company, do you, when you take out a policy loan? No, you don't. They just write the check and deposit it in your bank. Okay, but there's a strategy in how you can do that because, and you know this, um, these are really simple loans until the policy renews, right?
Right.
So if you were into a policy on January 1st, you take out a policy loan on January 2nd, and you paid back that entire policy loan before the policy renews, how much interest are you going to pay?
You're gonna pay less than whatever you're gonna essentially pay the interest on whatever less than a year. So if the interest is 5% on $100, you'd pay less than $5 if you pay it off before the end of the year.
When you pay it back, they rebate the interest charge.
Correct.
Okay. So essentially, if you can pay a nominal interest rate, nominal, okay, not a full 5% or 6%. So if you pay back at a higher rate, that money can't go into interest charges. Okay, where's it going to go? It's going to go into principal payment. If it can't go there, where's it going to go? Unscheduled POA. If you can't go there, where's it going to go? They're going to send the money back to you. It's not going to go anywhere. So when you don't steal the peas, what you do is you try to design these policies and pay them back as efficiently as you can to minimize the interest charges. Okay,
Right.
and some people talk about a 1090 policy as being a Frankenstein policy because it's so thin. Okay, you have no ability to really overfund a policy like that. Where if you design a more of a conservative policy and you keep room in the PUA, then you have a natural place to put additional interest,
Like
quote
a
unquote.
40% base, 60% PUA, that policy, in your opinion, has more ability to increase over time versus if you max fund from the very beginning, 10% base, 90% PUA, then you have a first world problem of saying, "Hey, I need to actually start a new policy at that time because you can't
Right,
put more into that policy."
right. Go back, the think tank we just did last month in February. John Parents did a presentation called, Be Bold, and he compared 7 pays with a long-term policy strategy and showed how they grow over time. Go look at that. What
Okay.
the difference between a
7 pays,
40/60,
what's your definition of a 7 pay? Like, paying till 7 years and then stopping versus paying ongoing?
7 years stop paying, buy another policy, 7 years stop paying, buy another policy, 3 successful policies versus doing a whole life policy uh, over those same 21 years.
I see.
But the point of a 1090, 10 base 90 PUA versus a 40 base 60 PUA, you know, you look at your dividends from your base policy, the base policy. Once the policy capitalizes over 13 or 14 years, look at the dividend compared to the premium on the base versus the dividend compared to the PUA. Okay, the base dividend blows it away. Why? What's a PUA? A PUA is a single pay policy. So in a $1 premium for a PUA buys much smaller insurance number, death benefit, than a $1 for a base. So as the policy continues to grow over the years, the base is the engine that grows the policy, not the PUA. It's the base premium. Okay, that gives you more premium, more dividends. Okay, a higher, not a more, but a higher dividend number. Okay, and of course the dividends get paid up additional insurance. So
Right. David,
plus you have more room.
yeah, I
You have
think
more room
there,
in a 40/60 than
yeah.
you do in a 10/90 and out years too to put
I
additional.
think here, can I push back a little bit on that? And
Yeah.
so there's two talking points that are really valid on the like 40% base, 60% PUA, and these are two really solid ones. Number one is there is more room. And then
Yeah.
number two, a lot of times when you do a 1090, you have to buy term insurance, which blends into that policy. And then you might have a first world problem of having too much life insurance that you can't qualify for more. So those are like two reasons why a 1090 may not be the right fit. The talking point of saying that the dividend is higher on that base is true, but if you look at the overall policy performances though and compare them to like a 1090 versus a 40/60, even though the 40/60 policy over time is going to maybe have better dividends, the
Mhm.
the 1090 in all these situations that we looked will have maybe higher IRR and higher cash value numbers, but that's
Mhm.
still but the point that I just made, flexibility,
Yeah.
that's one thing you have to look at. And then also like you're buying more life insurance and there may be a world and we've had clients that want more life insurance and they're tapped out. And so now they got to be more creative where if they did a smaller policy, they could get another one. So I want to, for my listeners who've heard me talk, I want to at least address that. And I think that's the
Yeah.
importance of like working with someone that understands your situation and can tell like can really help
Yeah.
you navigate the pros and cons of that.
Yeah, I guess that goes back to the think long range point also, but your 2 points, and I agree with those too. Uh, it's, if somebody says, "Hey, listen, I wish I bought more," well, guess what? You can't buy more, like you said, because you got this massive term right around there. Um, and, the more flexibility you have of the policy like that, the more flexibility you have, okay? If you're tied up where you can't do anything about it because it's gonna mech. If you have a if you have something there's a dividend change, okay? If you have a massive loan on a policy, you can mech it, even though they're quote unquote mech stressed. You know that. Okay, let me move to the last 2 points before I forget them. Okay, don't do business with banks is the fourth point. Uh, and there's a lot of pushback there because what does that mean? I can't have a checking account. No, you can have a checking account. I can't have a home mortgage through a conventional bank. No, you can have a home mortgage through a conventional bank because I don't know many people that can afford to fund a personal mortgage, okay, through their portfolio at this point. But eventually, you'll be able to do it. But when I say don't do business with banks, the reason that Nelson felt so adamant about that is because bankers are not good people. Kale, didn't you work for a bank when I first met
Yeah, I
you?
did. That's okay. Yeah.
There you
I did
go.
work at a bank and they were
Okay, there you
very
go.
nice
So,
people. At least
the
the community bank that I worked at. Yeah.
so the bankers are your best friend until they're not.
Yeah. They bankers love loaning money to people that don't need it, and they're not a big fan of
Yeah,
loaning money when you really, really need it.
yeah, yeah, they're not good people, okay? Now, but it's a little bit more than that. It's like, okay, w the folks that still think that you can buy a life insurance policy and use that policy as collateral for a bank loan is like, uh, that's not what we're talking about, right? Uh, and there's a big push out there to go and get HELOCs to fund policies. I'm not a real big fan of that either. So that just think about that aspect of it if you're trying to
When you
figure out
say
what.
don't do business banks, Nelson accomplished that. But so you almost said that that's a rule, and then you're making exceptions to the rule to say
No,
checking. We're not talking about checking accounts. We're not talking about mortgages. What are you talking
no,
about when you say don't do business with banks?
I don't do business with banks either. Okay, everything we do, we fund it out of our policy construct. Okay, the house I'm here now was built out of policy loans,
You have a checking account
and
though.
yeah, I have like wait a minute, let's see how many checking accounts do I have. I have 1, 2, 3, 5.
Okay.
Okay.
But you don't have any loan. You're debt free from the commercial bank side. You may have
Right.
outstanding policy loans with your
Right.
family's banking system, though.
Right. Now, a lot of people, you know, another thing that Nelson used to say is don't major into minors. It's like, but I want to get a conventional mortgage so I can deduct the interest. That quote unquote, you're majoring in the minors. Okay, you're not maintaining your. If you maintain the cash flow yourself, you're going to exceed any interest savings you're going to have, through or tax savings you're going to have through interest. But yeah, I mean, if you have a system in place where you can afford to mortgage your own home, then absolutely do it. Okay,
Okay.
um, and like I said, we haven't had a conventional loan since I don't know 2003 or something like that.
And David, do you
Every,
have
every
you have kids? I know that you mentioned the the tragedy that happened with one of your
oh
kids. Do you have a family?
oh yeah, we had 4 kids and 9 grandkids.
And are they not doing business with banks? Is your banking system able to help them?
They they for the most part they're not doing business with banks for. I think one of them is, we financed his house for him, but the rest of them have conventional mortgages through homes because we're not gonna they have to do it themselves.
Right.
But basically all the cars they drive are financed through policy loans, uh, educating, their kids, uh, a couple of them go to private schools, so that tuition comes out of policy loans.
Mhm.
Um, you know, most of them do IBC at their level. Okay, we don't if they ask us for help, we don't if we own a policy on them, then we'll go ahead and, we'll do a policy loan. One of the things I talked about at the think tank, I keep going back to think tank, was, one of the presentations I did was multi-generational, planning. Okay, and it's right out of the book, Becoming Your Own Banker on page 71, and I talked about, okay, Nelson used us as guinea pigs. And so we have a lot of $2,000 annual premiums on our children, and he bought them on his grandchildren, and so he could replicate what he talked about in the book, and I talk about that in the presentations.
That's cool.
Um, and then this past year, the next step was starting to offload some of these policies, transfer the ownership
Mhm.
of the policy to the kid. Okay, multi-generational. So the grandparent buys a policy on the grandkid, and then the grandparent gives the policy to the parents of the kid. The kids continue to fund that policy for 10, 15, 20 years. And then eventually the policy goes to the kid. And so now you have a policy that's 50 years old. And so that child has got a policy that's up and running. They can use that to fund other policies, even though we talked about policy loans, paying premiums, but this is a 50-year-old policy. So anyway, so the next step was for us, my daughter leaves, like say, listen, I wanna buy that car. And it's an expensive car. I wanna buy it and I wanna, my policies loans are maxed for tuition, this, that, this, that, this, that. I know you own a policy on me. Can you lend me the money out of the policy to buy a car? Well, lend the money from, it was really insurance companies lending. I said, yeah, we can do that. And so, and I said, oh, by the way, we're going to transfer ownership of that policy to you after we borrow the money to pay for the car, for you to pay for the car.
Yeah.
So what happened was I took out this policy had $75,000 cash surrender value. We took out a $65,000 policy loan. Interest on top of that took it up to about $69,000. As soon as I got that check deposited in my bank account, I submitted paperwork to transfer the ownership of the policy over to her, and so she acknowledged that and received the policy. So she has a policy that's been up and running for 20 years, $2,000 annual premium.
Yeah, it's amazing.
But it's got a $69,000 loan on it. So you're gonna buy a car, Now you got the loan, you
Yep.
service the loan yourself, it's yours.
What interest rate does your family use for paying back the loan with interest?
We don't really focus on that, to tell you the truth. I don't know why,
Okay.
but we don't.
Okay.
Uh,
So you're just paying the minimum, you're not
yeah.
paying extra?
What they do, what they do is when we financed when we did the loans for them and we own the policies, they just set up direct deposit into an account. So we do an amortization table. Typically it was like 8 to 10%, but my wife handles all that stuff. And every month, $1,000, $2,000, whatever, would go into her bank account. Boom, boom. She had a segregated account, and she manages that. Okay, we have a bunch of outstanding policy loans. Most of those are on the kids, but the last one, we actually transferred ownership to the uh, to the kid. So now
Nice.
the policy loan is for,
That's awesome.
something they have to service themselves.
What's number 5? And then I got some questions about rule number 4, but I wanna get through the five
Okay.
rules.
Okay, number 5 is probably the most important one. That's rethink your thinking.
That's good.
Rethink your thinking. Okay, Jason Lowe came up with that one for Nelson, and that's constantly learning, constantly, reevaluating what you're doing and why you're doing it, and continue to grow, continue to educate, continue to read, continue to talk to people, and keep thinking about what you're doing and why you're doing it, and so you're not just stuck somewhere. So
Okay. Thank you for this. I have a few more questions. You have a few more minutes for me? We
sure.
got there. Okay. The question I have is when I think of Nelson, I actually think him and Dave Ramsey have a lot more in common. Obviously, Dave's not a big fan of life insurance. I think that's a fair statement. But they actually have a
Yep.
lot of principle. Like they have similar stories. And it's interesting. Dave, went through hardship and then just is like anti banks, anti debt. And Nelson, I would say, is anti banks, but is ironically talking about how you can become your own banker. Do you agree with that? Have you ever thought about that? I just, I do content, a lot of content. I see lots of different things. I see a lot of patterns. They're both like iconic in different ways. And I just didn't know if Nelson admired Dave Ramsey behind the scenes on just like some of the other principles that he had or not. I'm just curious what your take is on that.
I wouldn't say he admired Dave Ramsey. He said that Ramsey stopped too short. Get out of debt, get out of debt, get out of debt. That's important, yeah. And manage your cash flow, yes. But he didn't take it to the next level and actually grow your cash flow by reclaiming the banking function. Um, and so that was a nice way we talked about Dave Ramsey. The bad way was about it. I mean, Dave has monetized his message, and he can't change it because that's his core message. I mean, if I came out and said, IBC, we were really wrong. IULs are really the way to go.
That'd be
Okay.
detrimental.
So
Yeah.
if Dave Ramsey came out and said, no, I was wrong. Dividend paying whole life insurance is really a great asset. He would have to take a step back, and it might be something that would not be good for his career. I don't know, but
Yeah. No, I
he,
think that's a fair statement. You just made a point that I think is valid, and I remember Nelson saying this indirectly. I don't know if you've ever directly said it to me, but he made mention to where he almost wished he wrote the book without illustrations because the
oh yeah, he
numbers.
said that. He said that more than once. Yeah,
Is there in going back is there anything else that he would have taken out or added, knowing what he knows now? I mean, I know he's passed, but there's been a time where he's probably seen people butcher, mislead, and I think I had to reread that book a couple times, and it was mainly because I'm very, very analytical. I mean, we've had conversations, and
yep,
I think he was like trying to make it easy, and so he actually like used it like did withdrawals and other things, and like to try to simplify it. But in my head, it was like more because I was trying to like figure out how every number works, and it was difficult.
yeah,
So,
yep.
is there knowing what you know, is there anything that you wished was added or subtracted from the book that you feel like has maybe created more confusion than good just in the book itself?
Um, well, let me just start with the illustration piece. A lot of individuals will look at the illustration, especially equipment financing in the book, and they think that's a policy illustration, which is not. Okay, those columns all come from multiple uh, illustrations from the insurance carrier, and what he did was he put those together so you could track cash flow through that construct and show how you can finance equipment in this case. And if there's room in the policy by financing equipment and repaying interest one way, principal another way, partial surrenders another way, how you can continue to grow that policy because there's room in it to put additional funding in there as you're financing your equipment. So that just was totally freaking confusing for everybody. And that's what he got frustrated about. The second piece was, wait a minute, that book was written in 2000. Okay, interest rates were much higher back in 2000. And I mean, we all know that, you know, policies don't perform like they did in 2000 or even 2008 or 9, okay? But so an agent would look at that and say, this policy, I can't do it today. I can't write a policy that looks like this today. True, because of interest rates and dividends and whatnot. But it's about the relationship of the numbers. That is important, and you have to understand that. So that was another thing that why he didn't want illustrations in there. Okay, anything. So if there was anything he wanted to add, well, besides taking those illustrations out, the only thing that he wanted to add, and I'll take credit for this, the very last part in the book is points to consider. Okay. I asked him to put that in there. It's kind of a yellow brick road. Okay. So that's the only thing he added. Okay. After the book was first published, because it was like, okay, now that you read the book, okay, points to consider. If you can grasp this, then this is going to work for you. Okay.
Yeah. So it's more of like a practical, like, hey, you read a lot, but like here's kind of like let's bring it to some things to consider to help you make the best decision on your next step.
Right. Yeah.
Yeah.
And I talked about standardization for the training program way back when. Well, maybe I didn't say that, but try to put, we put together a training program that had standardized language. Okay, where there's no such thing as a banking policy, even though I
Yeah.
probably said it 3 times in the last hour. Okay, it's a whole life insurance policy used for implementation of the infinite
Right.
banking concept. Okay, money dumps is kind of a word that's not doesn't mean anything. What's a money dump? Okay, is it
Yep.
paying additional premium? But so try to standardize what this really looked like, and then based upon what the client's understanding of it was, how they wanted to use it, what was the best construct that serviced their goals and needs and aspirations that they could manage because they're becoming their own banker. Caleb, you're not their banker. I'm not
Right.
their banker. They are their own banker,
And
but if they don't
really
know
it
how to
has
do
less
it.
to do with whole life insurance and more to do with reclaiming the banking function. And
Yeah.
so and that was I have lots of questions I'm gonna pepper you with the minutes that we have left, but whole life insurance, do you find that strategically, like, when people think of infinite banking, they think of whole life or they
Mhm.
think of life insurance, but it really is a process and a concept, and then whole life just happens to be the asset of choice that a lot of people would use when you start thinking about, like, that perfect asset. Could someone do this with other assets? And be just fine? Or is there something really special about whole life and its marriage to the infinite banking concept? Hey, I want to interrupt this video real fast to tell you about our clarity call. We designed this clarity call for the entrepreneur, the high income earner, the person that wants more control, the person that is ultimately asking the question, how can I better my finances? And this clarity call is simple. We get clear about your situation, and then we try to answer the question, does integrating overfunded whole life insurance help you better your financial situation? Does it help you be more efficient? Does it help you better accomplish your goals? If
if the answer is yes, we'll actually show you how it does. We can walk you through those steps on what it would look like to getting permanent whole life insurance in your financial situation. If the answer is no, you'll have clarity on this is not the right fit for you. And so if you're someone that's been wondering, does the strategy work? We've designed the clarity call for you. No pressure, no fluff. We just, again, want to help you get real clear on, is the strategy a right fit? Make sure to click the link in the description or the pinned comment below. Let's get back to the video.
There's something special about whole life, and it's called uninterrupted compounding. Okay, that's the main thing. Okay, because there, as you know, that a whole life policy is not an account. Okay, there's no money in a policy. All it is a contract. Okay, a unilateral contract. As long as you make premiums in that policy, it's going to be in force. And so you have a cash surrender value, which is uninterrupted compounding, regardless of how many policy loans you take out. So that's number one. I don't know anything else that's got that uninterrupted compounding that can be used for this thing. Number two is it's private. Okay, it's not a qualified plan. It's not something that you have to get permission to use or somebody gives you oversight. Okay, so those three things are really why the permanent whole life is really the only thing you can use. Yeah, you can put $1 million in a mattress and borrow from that, but every time you have, it's a sinking fund, right? Boom, boom, boom. So what else do you think
No,
makes up?
I'm with you. It's that, and a high yield savings account is a second, and it's inferior in a lot of different cases. The advantage to it is you have maybe earlier liquidity, but you think long range, 30, 40 years, it's going to be a very big difference between where you store your money. And that's just one thing that I think has been really helpful in language is like, where do you store your money? How are you using your money throughout your life? And that one decision could be $1 million differences depending on, and when you think multiple generations, it could be multiple millions, just where you store your money. And so that's, yeah, I just wanted to get your thoughts there. What are your thoughts on people that talk about infinite banking on YouTube, Instagram, TikTok, presentations that are not a part of the Institute?
Well, it depends what they're saying, for the most part. Um, you know, if they're saying, infinite banking is a great concept, and I do it better than anybody else because of X, then that's BS. Okay, they're not doing it better than anybody else. Okay, so don't say that. Again, they're trying to sell something. And people that promote this are doing it because they're trying to sell a product. If they, you know, if they say, infinite banking is free to the public, it is. Nelson created the infinite banking concept because he wanted everybody to have exposure to it. Okay, he was a Christian, and and as a Christian, everybody needs to be exposed to the gospel. Okay, that's rule number one. If they're not exposed to it, then they don't have the ability to receive grace. Same thing with IBC. If they're not exposed to it, then they're not going to know how to do it. So we didn't create a wall around IBC, and you got to pay to get in the gate to learn about it. It's open for everybody. Okay, you just got to do it correctly, and don't pollute the water with either ignorant comments or concepts or disingenuous
Yep.
information.
It's interesting because people that are a part of the Institute, it feels like you can have a little bit more control because you can say, "Hey, Caleb, because I'm a part of the Institute. Hey, if you don't correct this, we can't have you be a part of our Institute because you reflect on us."
Right.
But people that aren't a part of the Institute, harder to control because it's like they're not a part of the Institute. You can call them out. And that's what I'm hoping goes forward is like you could almost have like a weekly roundup or a monthly roundup to say, "Hey, these are all things, and we just want to issue a statement. We do not endorse this." And in fact, like it, and that could be really powerful because how many people are part of the Institute? How many hundreds of people?
We have, I think we have like 330 or 40 active
Those are
practitioners.
amplifier. Those people can
Yeah,
amplify that message, and then they can say, "Hey,
yeah.
like So I just a thought around, like, as maybe there's a place where you guys can go on record. And then obviously you mentioned that the 3 people have been terminated. The I obviously we have a I have opinions about different insurance companies, and you have a problem with saying you can't do infinite banking or that they're inferior. Because, like, that is something that is I alone have videos that we talk about the pros and cons of different insurance companies. I don't want to burn any bridges with anybody, but when looking at things, so do you have a problem with that, or is it mainly just like the black and white statement that these are the only 4 companies that you can do something with?
No, no. I mean, you know, what I said earlier, when this individual said the only 4 companies that you can do business with, you're wrong. Or no, the only 4 companies you should do business with
Yeah.
are these massive mutuals. And if they supported IBC, that'd be fantastic. I'd say, yeah, let me sign a contract with Northwestern, and they can have exclusive rights to IBC, whatever. No, the thing is, the rules of thumb, use a mutual or a mutual insurance holding company.
Right.
Right. Okay, that's number 1. It's got to be one of those. And number 2 is, you probably want something that's got the capability to have a paid-up additions rider on it. You probably need that. You don't absolutely need it, but you probably need it so you can generate some cash value early on and get this thing up and running. So really, those are the only rules for insurance companies.
But
Now,
you would
there's
say
companies
if
that
yeah, just go. Sorry, I cut you off. I know there's people that might represent one insurance company, and I've heard
Mhm.
many people say, like, this company's the best. But, like, you don't have a problem necessarily with that because it's an opinion. Because it just feels like if someone says you can only do it's their opinion, and they're not speaking for the institute. And I know the person you're talking about, and I'm not endorsing him, or, like,
Right.
trust me, I'm not at all. I just wanted to gain, like, insight because I probably, if you watch all my videos, I probably could be on the chopping block every month. I'm serious. I'm
No.
sure you get people sending videos, and I'm like, I'm just waiting for that day that I get a call from you that says, hey, Caleb, love you, but you
No,
can't be in.
if you prefer a company over another company, there's nothing wrong with that. If you prefer a company, because they're non-direct recognition over a company that's direct recognition, and that's the way you like to use them, that's fine. But
Yeah,
if you say the only company you should do business with
I see. Okay, okay, that's fair.
is
That's fair.
Mass Mutual, the only company you should do business with, boom, then I'm gonna
Yeah,
call you out on that.
yeah. What's your thoughts on Mass Mutual writing that letter memo a couple of years ago about infinite banking?
Well, my thoughts are, again, I don't have any insight, but my thoughts are probably, uh, individuals who didn't know what they were doing.
Yeah,
Who
abusing
who
it.
were agents, either career agents or brokerage contract agents that were touting IBC who didn't really know what the hell they were doing. I my idea is that Mass says, "Okay, we're just gonna shut the whole thing down." Okay? And so the ones that are doing it right are gonna suffer the consequences. However, um, if I'm a Mass Mutual agent and I submit a policy that's got a 40% base, 60% PUA with a nominal term rider on there, and it doesn't say IBC anywhere on the application, how are they not gonna accept it?
Oh, and just for the record, our mass person gave us a call and said, "You guys are totally good." And again, we're just taking hearsay, but it's like they had some people. There's a few people that can really poison the well, and we're really abusing it and
Yeah.
buying groceries, buying their gas. Like, sounded like a total nightmare, and it gave them a bad rap. And I think mass has, like, got more to lose than gain from any concept. And so, other than maybe Security Mutual, I don't know if any insurance company goes out on their letterhead and says, we endorse a strategy. There's obviously a lot of companies that endorse it, that go to the institute or go to the think tank, but it's like, it's very rare for insurance companies to endorse a system because there's more downside than upside when it comes to giving an endorsement. So
Yeah.
it's just a thought. I think are the only company that have had issued a memo like that. And then last thing that we can end on is the don't do business with banks. And let me ask you this. This is a
Mhm.
I so I'm not going to throw anyone under the bus other than myself here. Okay.
Okay.
I'm not the only one that believes this, but I will just be talking to me. So one of the things as I was learning about the power of the infinite banking concept is the importance of saving more money. It's a volume. If I can save, if we can get a family to save more money into their system, into life insurance, over time they're going to be better off than the person that's saving less. If you have identical person A versus person B, and person B is saving 30% into life insurance, and person C or A is saving 25%, everything else is relative. Everything else is the same. Obviously, person B is going to have more money, greater legacy, and all. And so I have no problem at all with the principle of saying we're not going to do business with banks, period. Like, we're not going to do business with banks. I do not think they're good people. And I am going to actually end up paying more because of that belief. Where I have an issue is when people use that and then gaslight me, telling me it's better financially for them personally, when it's actually not. I'll take an example of like two examples recently that came up. Example number one is just a basic car loan, and I'm gonna make an extreme example. It's not to say this is real, but an extreme example number one is if I have a car, the price is already negotiated, and I could get a loan from the car dealer at 2% or a loan from my insurance company at 6%. No matter how many gymnastics you play with simple amortized compound, like the cost of money, the cost of peas are $2 over here and $6 over here, just pure cost to put them on the shelf. Not like, we're not even talking about paying them back. It's just, and so for me, I'm like, I don't think I'm disrespecting my family by going and buying $2 peas when it literally costs them $6. In fact, I should buy 3P. I should be buying it from the 2% and stocking our shelves. So that's thing number one. And then the second thing is there are people that are paying off mortgages fast, like 30-year mortgages, aggressively, refinancing it into a life insurance, and in some cases at a higher rate. And from a planning standpoint, I go, you are losing more. Like, you literally went from a cash position of capital, and now you're like, now you have zero, like you have no, for me, it hurts, because it's like, not only are you paying extra interest, not to the evil banks, but to the insurance company, but you actually have less capital position. So I actually think, and I'm not trying to like, I actually believe in what Nelson and I practice, and I fund a lot of money into life insurance, but it's those two examples that I would choose to work with the bank for my family, but acknowledging that, yeah, this is part of the issue because of printing, and so I have the utmost respect, whether your name is Dave Ramsey or Nelson Nash, to say, I'm not going to do business with banks, period, because of principle. Great. But where I push back on is people that then try to give me like a word salad gymnastics on how actually you're better off for your family by doing the life insurance versus the bank. And I just don't know if you had a comment on that. We could maybe do part 2. There's no wrong answer. I just wanted to know your stance, because out of all the things that you mentioned, that's probably the thing that I struggle with. And I openly talk about it on the show. And I'm just curious your take on that.
Well, going back to the car example, if you're financing the same exact number you can pay cash on a car, you're a fool. Okay, that's number one. Because I don't know any dealership that says, okay, you can have the GMC truck for $50,000, either cash or we'll finance it at 50. Because typically you can always get a better deal for cash. That's number one.
That's definitely something to look at. And I'm with you. I've been shocked these last 5 years in the car market. I don't know when the last time you bought a car was. It used to be that way, and now they are a lot more strict. But I will say, a cash buyer you should have better options if you're coming to the table with cash. And so I'll concede that.
You should, whatever. Like I said, I don't know. Most people, when they look at IBC, they try to kill the highest principal interest debt that they have, and they usually start with credit cards, right?
Yeah, highest interest rate. Okay. Yep.
Yeah, highest rate credit cards. And that's the first thing they kill, and then they work it down towards lower interest accounts. But anytime that you take the bank out of the equation, you're better off, because you can look at internal rate of return, you can look at return on investment, you can do all that gymnastics like you said, but there's an intrinsic value with controlling everything. Okay, and I don't know if you can put a cost on that or not. Control is a very important aspect of everything
Yeah,
related to
but who
IBP.
has more control? The person A who took all their money in their life insurance to pay off the mortgage, or person B who's keeps that liquid capital in their life insurance policy and pays the mortgage company, and it happens to be a lower rate at the same time. That's
Mhm.
I would actually say that person B has more control in that situation, but they're doing business with banks, which by principle could be against their like, for example, we're both Christians. There's certain things that we're not going to do, no matter how great of a rate of return I can make from investing into a company that doesn't share. I'm not going to do it because I'm not.
Yeah.
My principles aren't for sale. So I just like I'm. So that's what I've always told people is just because it's not mathematically the right way. There's sometimes principles mean more than the math.
Yeah. Well, the bottom line is, everything's good with the bank until it's not, okay? And who knows what that looks like when you get a note called. It's like, I mean, like I said, when they want their money, they're not nice people. That's the bottom line.
Yeah.
So, uh, just think about it like that. That's how I
Yeah.
think about it, because we're talking about, yeah, your liquidity and the policy. Don't use all your liquidity to reclaim the banking function if you don't have to. I mean, there's no one right answer, okay?
Yeah.
And that goes to the next level here we don't have time to talk about today, and that next piece is your premium should equal your income.
Yeah. That's created a lot of.
That's a 1-hour discussion right there. What does that look like?
Okay, maybe part two. Let us know if we want to have part two with David. David, thank you so much for coming on. And I admire you. Thank you for doing what you're doing from a leadership standpoint. Can people that aren't practitioners attend the think tank, or is that just for practitioners?
They can come as guests of a
Okay.
practitioner.
Okay,
Yeah.
we'll have the link there, and then you guys are doing a phenomenal job on YouTube. I'll also link that. We might even collaborate on this video to help promote what you guys are up to. If there's anything else that you want to include down below, we'll have that, and we'll have you back on. And we'll read all the comments and see what some of the biggest questions are, and we might have to have your income equal premium conversation for part two. Thank you so much for coming on.
Okay. Thanks, man. Appreciate it. You take care of yourself.
If you're an advisor, life insurance agent, or someone who just loves the life insurance space, we have a must-attend event for you. It's our 5th annual Life Insurance Summit, June 15th through the 17th, right here in Nashville, Tennessee. Not only are we going to have the biggest names in the life insurance space, but this is also an incredible opportunity for you to meet and connect with like-minded individuals and be a part of our ever-growing community. Learn more and get your tickets before they sell out in the link in the description or pinned comment. Can't wait to see you there.